Stop everything you're doing and listen to this, because what I'm about to tell you is so shocking, so unprecedented, that even Elon Musk publicly warned about it just 3 weeks ago. As of January 23, 2026 at 2:15 a.m. Eastern Time, silver is trading at $98.93 per ounce, less than $2 away from the psychologically massive $100 barrier. Just 12 months ago, silver was $30.89. That's a 220% gain, 220% in 1 year. But here's what's truly insane. This isn't even close to being over. While everyone's been obsessing over gold hitting $5,000, silver has been quietly staging the most violent supply squeeze in modern commodity history. China just weaponized 60-70% of global silver supply by restricting exports starting January 1st, 2026. Global inventories have collapsed 70% since 2020. The world is running out of physical silver at the exact moment when solar panels, electric vehicles, and AI data centers need it more than ever. And when I show you the data, real data from Citigroup, De Beer Group, Bank of America, and over 25 authoritative sources, you'll understand why this isn't speculation. This is the most asymmetric opportunity in the precious metals market right now, and you're in exactly the right place to understand it. Stay with me for the next 20 minutes, because I'm going to show you why silver isn't just going to $100. It could be heading to $200, $250, or even higher, according to some of Wall Street's most respected analysts. Let me paint you the complete picture of the absolute chaos unfolding in silver markets right now, because the numbers are genuinely staggering, and most people have no idea what's happening. Silver closed at $98.93 per ounce on January 23, 2026, according to JM Bullion's live pricing. That's $3.18 per gram, or 3,180.67 per kilogram. Just 2 days earlier, on January 21st, silver hit an all-time record high of $96.91 per ounce before pulling back slightly. We're now consolidating just below the critical $100 psychological level, a threshold that silver hasn't even come close to in its entire history. Let me give you some perspective on how extraordinary this rally has been. On January 20th, 2026, Fortune reported silver trading at $95.32 per ounce, representing a $64 gain compared to 1 year ago. By January 21st, it had surged to $96.91. By January 22nd, APMEX recorded a new all-time nominal high of $96.60, and by January 23rd, we're at $98.93. This is parabolic acceleration of a magnitude that commodity markets rarely witness. Trading economics data shows that silver has risen 220.15% compared to the same time last year, and over the past month alone, prices have exploded 36.04%. Now compare this to historical context, and the significance becomes crystal clear. In 1980, silver reached $49.45 per ounce during the famous Hunt brothers attempt to corner the market. That was the previous nominal all-time high that stood for 45 years. If you adjust that 1980 price for inflation using 2025 dollars, it would be approximately $194.42 per ounce today, according to APMEX analysis. In 2011, silver made another run at $50, hitting $48.70, but couldn't break through. For 4.5 decades, silver remained trapped below that $50 ceiling. Then in October 2025, the dam broke. Silver blasted through 53,765s. In November, it reached 57,245s. In December, it exploded to $80.67. And in January 2026, we're approaching $99. The global market dynamics tell an even more dramatic story. In India, which represents one of the world's largest silver markets, prices have gone absolutely vertical. According to 5 Paisa Capital data, Indian silver prices surged from Rs 249 per gram on January 9th to Rs 340 per gram by January 23rd. That's a Rs 91 increase in just 14 days. On the MCX, multi-commodity exchange, silver March futures hit a fresh record of Rs 339,927 per kilogram on January 23rd, surging over Rs 12I600 in a single session, a nearly 4% daily gain. The national average for silver in India stands at Rs 327,280 per kilogram, with Chennai leading at Rs 327,640 per kilogauss due to strong southern demand. Silver is outperforming gold on a percentage basis by a significant margin. While gold has gained approximately 77% year over year, itself an extraordinary performance, silver's 220% gain represents nearly triple gold's appreciation rate. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has compressed dramatically from the typical 70-90 range down to approximately 50.1 as of January 2026. This ratio compression signals that silver is finally catching up to gold's valuation after decades of underperformance. Bloomberg reports that silver touched a record high of 96.91 per ounce, consistently outperforming gold throughout 2025 and into early 2026. According to bar chart analysis, silver's parabolic rally has continued into 2026, with the COMEX March futures contract reaching $95.78 per ounce on January 20th as the metal continues making higher highs. The monthly continuous COMEX chart reveals that we're witnessing the kind of price action that can take prices to illogical, irrational, and unreasonable levels that defy technical and fundamental analysis. But here's the critical insight. This rally isn't irrational at all. It's the inevitable result of 5 years of structural deficits finally manifesting in explosive price discovery. And the forces driving this move are just getting started. Unlike previous silver rallies driven by speculation or inflation fears, the 2026 explosion is powered by 5 interconnected structural shocks that are fundamentally repricing silver's role in the global economy. These aren't temporary factors. These are multi-year, possibly multi-decade trends that cannot be reversed. Shock number 1, the 5-year supply deficit crisis. This is the foundation of everything happening in silver right now. For 5 consecutive years, global silver demand has exceeded total supply, a structural imbalance unprecedented in modern commodity markets. In 2025, global silver demand reached an estimated 1.24 billion ounces, while total supply, including mine production and recycling, amounted to only 1.01 billion ounces according to FX Street analysis. That's a deficit of over 230 million ounces in a single year, equivalent to the entire annual output of Mexico, the world's largest silver producer. The Silver Institute confirms this deficit is entering its 5th consecutive year, with 2025 marking a shortfall of approximately 149 million ounces. According to CME Group's Precious Metals Outlook 2026, industrial consumption continues to outpace mine supply, resulting in a 5th consecutive year of market deficit. Unlike temporary shortages that resolve through higher prices stimulating production, silver faces unique structural constraints. Most silver, approximately 70-75%, is mined as a byproduct of other metals like copper, lead, and zinc. This means silver production is determined by the economics of base metals, not silver itself. When copper prices are weak, silver production falls regardless of how high silver prices climb. This creates persistent supply inelasticity that cannot be fixed quickly. Shock number 2. China's export weaponization, the January 1st game changer. On January 1st, 2026, China implemented the most aggressive silver export restrictions in modern history, and the implications are catastrophic for global supply chains. Under the new licensing framework, only large, state-approved companies with annual production capacity exceeding 80 tons can export silver, and only after obtaining special government licenses. This effectively cuts off 60-70% of the world's refined silver supply from international markets, as China controls the dominant share of global silver refining infrastructure. When Elon Musk tweeted, "This is not good. Silver is needed in many industrial processes," in response to China's announcement, he wasn't exaggerating. China's move mirrors their earlier strategy with rare earth elements, where export controls were used to secure domestic industrial advantage and exert geopolitical leverage. According to Investing News Network analysis, the bifurcation between paper silver markets, COMEX futures, and physical silver markets has exploded. In Dubai, physical 1-ounce silver coins were trading at 90.93 on January 2nd, while the COMEX March 2026 contract closed at just 72.65, a premium of over $27 per ounce for physical delivery. The ratio of paper silver contracts to real physical ounces backing them is now 356 to 1, according to Asset Strategies International President Rich Chekin. That's an inordinate amount of paper promises for every physical ounce of silver backing it. When the credit of the paper-silver system fractures, and it's fracturing right now, institutions demand delivery, and the entire price discovery mechanism shifts from futures markets to spot markets where physical scarcity dictates price. Shock number 3. The industrial demand explosion, solar, EVs, and AI. Silver's industrial demand profile has fundamentally transformed over the past decade. Industrial applications now account for 50-60% of total annual silver consumption, approximately 550-600 million ounces, according to Discovery Alert Research. This represents a seismic shift from silver's historical identity as primarily a monetary metal. 3 sectors are driving exponential demand growth. First, solar photovoltaics. Each solar panel requires approximately 20 grams of silver for its conductive efficiency, and there is no viable substitute that maintains the same energy conversion rates. The International Energy Agency estimates that by 2030, the solar sector alone will consume approximately half of global silver output. Second, electric vehicles. Each EV uses up to 2 ounces of silver in sensors, wiring, and power modules, far more than traditional combustion vehicles. Third, and most underappreciated, is AI infrastructure and data centers, which require massive amounts of silver for their electrical systems and cooling infrastructure. BMI, a unit of Fitch Solutions, projects the deficit in the global silver market will continue throughout 2026, primarily driven by higher investment demand. According to their analysis, inflows into silver ETFs have surged, while demand from solar panels and EVs has tightened the physical market to an unprecedented degree. Business Today reports that India's industrial consumption, particularly from solar and electronics sectors, has created a sharp spike in demand, with over 170 million ounces imported in the first 10 months of 2025 alone. Shock number 4, the strategic metal reclassification, government accumulation. In 2025, the United States officially classified silver as a critical mineral, a designation that fundamentally alters how governments view the metal. This isn't just bureaucratic labeling, it signals that silver is now viewed as strategically important to national security and economic competitiveness, similar to lithium, rare earths, and uranium. Russia moved first in this space, with the Russian central bank beginning silver accumulation as part of their de-dollarization strategy under Western sanctions. According to Trading Key Analysis, emerging market central banks such as those of Russia, India, and Saudi Arabia are adding silver to their strategic reserves, treating it not just as an industrial input, but as a monetary asset. This represents a dramatic shift from the historical norm where central banks bought gold but ignored silver entirely. When governments start accumulating a commodity for strategic reserves, it creates a persistent demand floor independent of economic cycles. Strategic resource designations typically mean that official sector demand becomes structural and long-term, as governments are willing to pay premium prices to secure supply for domestic industries. Gold-silver analyst Alan Hibbard notes that silver enters 2026 with a persistent supply deficit, rising sovereign interest, and a shift toward easier monetary policy, a combination that has historically favored scarce assets. Shock number 5, the inventory collapse, physical metal vanishing. The visible symptom of all these forces converging is the catastrophic depletion of global silver inventories. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association, LBMA vaults, have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade, according to FX Street. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. When lease rates for silver, the cost to borrow physical metal, spike dramatically, it signals acute physical scarcity. BMI reports that China's export restrictions temporarily drove up leasing rates for silver to over 8%, converted to a 1-month term, more than 30 times normal levels during periods of acute stress. Such movements indicate that holders of physical metal are demanding enormous compensation for its scarcity, which represents fundamental support for prices that's difficult to ignore. Now let's dive into the technical structure and see what Wall Street's most sophisticated analysts are projecting, because the price targets being discussed are absolutely extraordinary. As of January 23rd, silver is consolidating at $98.93, just $1.07 below the critical psychological $100 level. This isn't just a round number. It represents a technical and psychological threshold that, once broken, could trigger the next explosive leg higher. From a chart perspective, silver has established a classic cup and handle pattern on the multi-decade time frame that technical analysts are calling the most powerful formation they've ever seen. Steve Penny, founder of silverchartist.com, told Investing News Network in January 2026, "This cup and handle is a 50-year formation that I've never seen anything like before. It's very, very powerful. $100 an ounce is very real, and it could happen as soon as March of next year." His measured move target from the cup and handle breakout points to $96 initially, which we've already exceeded, with extensions potentially reaching $250, $300 if the pattern plays out fully. The technical structure reveals silver breaking decisively above long-term resistance at $50 in 2025, marking what FX Empire analysts call a clear shift in market behavior, a structural change rather than a speculative spike. According to their analysis, the breakout from the cup and handle pattern in 2025 is projected to yield a gain of over 700%, similar to the 747% rally from the 1993 low to the $31 peak. If this move is measured from the $30 breakout level, it points to a potential target between $250 and $300. Now let's examine institutional price targets, because major Wall Street banks are issuing forecasts that were considered fringe just months ago. Citigroup leads the bullish camp, projecting silver reaching $100 per ounce in Q1 2026, citing heightened geopolitical risks, ongoing physical market shortages, and renewed uncertainty on Fed independence. This isn't some obscure boutique analyst. This is Citigroup, one of the world's largest financial institutions. De Beer Group goes even further. CEO Nigel Green stated on January 15th that silver could reach $200 per troy ounce by the end of 2026, emphasizing that the rally has significant room to run. De Beer's analysis cites structural demand, supply shortages, and ongoing uncertainty as key catalysts. They warn that while volatility will be extreme, the fundamental trajectory points decisively higher. Bank of America upgraded its 2026 silver outlook, now predicting the white metal will reach $65 and trade at an average price of $56.25. While more conservative than Citigroup or De Beer, Beauvais notes potential upside over the next 12 months and acknowledges near-term correction risk. UBS has lifted its silver price prediction for mid-2026 to $55, up from $47 previously, citing ETF inflows and fiscal imbalances. Felipe Geisels at BNP Paribas predicts silver could reach $100 per ounce by the end of 2026, though he acknowledges this as an aggressive forecast. Gold Silver's lead analyst Alan Hibbard published one of the most bullish forecasts. I'm expecting silver to perform better in 2026 than it did in 2025, Palmos 147%. I wouldn't be surprised to see the price of silver increase by over $100 per ounce to $175 plus. His analysis emphasizes that the market still hasn't fully priced in the structural deficits and explosive industrial demand building beneath the surface. Larry Leppard, a prominent precious metals investor, believes silver could easily reach $100 per ounce given the deeply entrenched structural deficit, with targets of $75 by mid-2026 and $80-$90 by year-end is realistic given the market dynamics, according to Scottsdale Bullion and Coin reporting. Philip Newman, MD of Metals Focus, remains bullish despite silver's sharp rally, projecting a potential price target of $70 per ounce for 2026. Dolly Varden Silver, a mineral exploration company, suggests silver could hit $73, outperforming gold on a percentage basis. Kitco News conducted a retail investor survey showing that 57% of retail investors expect silver to trade above $100 or Oz in 2026, an unprecedented level of bullish sentiment that either signals dangerous overcrowding or validates the structural thesis depending on your perspective. Technical indicators paint an interesting picture. The 14-day RSI on silver hovers around 72.75, technically overbought, but not extreme by historical standards for a commodity in a structural supply squeeze. The MACD has been in positive territory for months, confirming strong upward momentum. However, as Forex.com analysts note, investors may disregard overbought signals and continue monitoring underlying fundamentals rather than pure technical oscillators when structural forces overwhelm cyclical patterns. Support levels are critical for risk management. The most immediate support sits at $85-$90, representing the breakout consolidation zone from early January. Below that, $80 marks the December 2025 high and serves as secondary support. The psychological $70 level represents a key floor. Holding above this suggests the structural bull case remains intact. A breakback below $50 would be technically devastating and likely signal that the supply deficit narrative was overstated, though most analysts view this as extremely unlikely given physical market conditions. Understanding the supply-demand dynamics is absolutely crucial because this determines whether current prices represent a sustainable repricing or a speculative bubble destined to collapse. Let me walk you through the hard data, and I think you'll conclude, as I have, that silver's fundamentals are stronger than almost any commodity on Earth right now. On the supply side, the picture is remarkably constrained. Global mined silver supply in 2025 was estimated at 813 million ounces, according to Business Today, while CME Group data shows annual mine production has stabilized around 820 million ounces globally. Unlike other commodities where high prices rapidly stimulate production increases, silver faces unique structural barriers. Approximately 70-75% of silver is mined as a byproduct of copper, lead, zinc, and gold operations. This means primary silver mines represent only 25-30% of total supply. This byproduct dependency creates what economists call supply inelasticity. When silver prices double, it doesn't meaningfully increase silver output because mine operators are making decisions based on copper or zinc prices, not silver. According to CME Group analysis, supply elasticity remains low, as most silver is mined as a byproduct, meaning production levels are often dictated by the economics of copper, lead, or zinc rather than silver market trends. Discovery Alert research confirms this, noting that the capital-intensive nature of mine development means supply responses require 5 to 7 years of development time, creating persistent structural imbalances during demand growth periods. Recycling represents another potential supply source, but it's been surprisingly muted despite record prices. Goldbroker notes that although silver has increased nearly 150% in 2025, the decline in demand for physical silver was more than offset by strong growth in investment demand, while silver production is struggling to grow amid a persistent structural deficit. This is counterintuitive. Normally, when prices surge, recycling flows increase dramatically as owners monetize holdings. But in silver's case, much of the industrial silver is unrecoverable. It's used in minute quantities across billions of electronic devices, and investors appear to be holding rather than selling into strength. BMI does not expect any significant additional volumes from Mexico, the world's largest silver producer, in 2026, meaning supply will remain capped near current levels even as demand accelerates. Now let's examine demand, where the story becomes truly compelling. Total global silver demand in 2025 reached approximately 1.24 billion ounces according to multiple sources. Breaking this down by category reveals the structural shift. Industrial demand, 600 million ounces, 45 to 48% of total, driven by solar panels, consuming 100 to 140 million ounces annually, electric vehicles, growing 15-20% annually, electronics and semiconductors, steady at 280 million ounces, and emerging AI data center applications. Investment demand, approximately 450 million ounces in 2025, including ETF inflows, bars, coins, and institutional buying. Business Today reports that silver ETF inflows surged in 2025 with record inflow of 95 million ounces in the first half of the year alone, according to Macquarie. Jewelry and silverware. Traditional demand from these sectors has softened at elevated prices, particularly in price-sensitive markets like India. However, this demand destruction is being completely overwhelmed by surging industrial and investment demand, central bank and strategic reserves. This new category is difficult to quantify but represents a structural demand floor. When governments classify materials as strategically critical and begin accumulating reserves, price sensitivity declines dramatically. They buy regardless of price to ensure supply security. The mathematics of the deficit is staggering. With total supply around 1.01 billion ounces and total demand at 1.24 billion ounces, the annual deficit exceeds 230 million ounces, more than 20% of total supply. This deficit must be filled by drawing down above-ground inventories, which, as we discussed, have fallen 40-70% across major storage locations. CBS News analysis emphasizes that the silver market has been running a supply shortfall for several consecutive years, and that imbalance shows no signs of resolving in 2026. Mining production faces structural constraints, and without major expansion in copper, lead, and zinc production, new silver supply remains limited even as demand continues climbing. FX Street provides perhaps the most dramatic framing. In 2025, global silver demand reached an estimated 1.24 billion ounces, while total supply, including mine production and recycling, only amounted to about 1.01 billion ounces. This represents a deficit of over 230 million ounces, equivalent to the entire annual output of Mexico, the world's largest silver producer. When a market's structural deficit equals the entire output of its largest producer, you're not dealing with a temporary imbalance. You're witnessing a fundamental repricing. Responsible analysis requires examining multiple potential outcomes rather than cherry-picking the most exciting forecast. Based on comprehensive research from major banks, independent analysts, and technical experts, 3 primary scenarios emerge for silver in 2026, each with distinct probability weights and price implications. Base case scenario, 40% probability, $70-$100 consolidation and grind higher. The most likely outcome, according to consensus analyst forecasts, is that silver consolidates its extraordinary 2025 gains in a range between $70 and $100, potentially breaking above $100 in the second half of 2026, but experiencing significant volatility. In this scenario, industrial demand remains robust, but doesn't accelerate dramatically from 2025 levels. China's export restrictions create supply tightness, but don't trigger acute shortages. The Federal Reserve cuts interest rates 2 to 3 times in 2026, as futures markets currently price, creating a moderately supportive backdrop for non-yielding assets. Silver ETF inflows continue, but at 50-75% of 2025's record pace, representing healthy but not euphoric investment demand. The dollar weakens modestly throughout the year, and geopolitical tensions remain elevated but don't escalate into major conflicts. Recycling rates increase somewhat as prices remain elevated, partially offsetting the supply deficit. This scenario aligns with mid-range analyst forecasts. Bank of America's $65 average price, UBS's $55 mid-year target, Philip Newman's $70 projection, and Larry Lepard's $75-$90 year-end targets all fit within this framework. In this outcome, silver delivers solid double-digit percentage gains from current levels, rewarding patient investors while frustrating those expecting immediate explosions to $150-$200. Bull case scenario, 35% probability, $100, 200 plus, breakout. The bullish scenario envisions silver decisively breaking above $100 and potentially surging toward $150-$200 by year-end 2026. Probability is estimated at 35%, though this may be conservative given recent momentum and deteriorating physical market conditions. This outcome requires a confluence of favorable catalysts. China's export restrictions prove more severe than expected, causing acute physical shortages in Western markets. Industrial demand accelerates beyond projections as solar and EV adoption exceeds forecasts. The Federal Reserve pursues aggressive easing, 4+ rate cuts, in response to economic weakness or financial market stress. In this scenario, a significant credit event or liquidity crisis in broader markets triggers massive safe haven flows into precious metals. The paper silver market experiences a delivery failure or major default, forcing institutional investors to pay premiums for physical metal and creating a self-reinforcing squeeze. ETF inflows run at 100% plus of 2025 levels as mainstream investors finally recognize silver's structural deficit. This scenario is explicitly outlined by the most bullish forecasters: Citigroup's $100 Q1 target, De Beer Group's $200 year-end prediction, Gold Silver's Alan Hibbert expecting 175 plus, and Fex Empire's technical targets of $250-$300 from the cup and handle measured move all describe variations of this outcome. Steve Penny's analysis that $100 could happen as soon as March and his confidence in going higher in the fullness of time supports this scenario. The trigger for this scenario could be remarkably simple. Once silver breaks cleanly above $100, it enters uncharted territory with no historical resistance levels to slow momentum. Algorithmic traders and momentum funds pile in, retail FOMO intensifies, and industrial buyers panic purchase to secure supply. The combination creates a self-fulfilling feedback loop that drives prices far higher than fundamental analysis would. Bear case scenario, 25% probability, $50-$70 correction. The bearish scenario, assigned approximately 25% probability, requires a significant reversal of current trends and fundamental conditions. The catalyst would be a major positive surprise in silver mine supply, highly unlikely given byproduct constraints, a collapse in industrial demand due to global recession reducing solar and EV manufacturing, aggressive Federal Reserve rate hikes in response to resurging inflation, crushing precious metals, or a resolution to geopolitical tensions allowing risk-on rotation away from safe havens. In this environment, the dollar strengthens significantly, U.S. Treasury yields surge, and equity markets rally strongly, creating powerful headwinds for silver. ETF holdings would see sustained outflows of 200-300 million ounces as investors rotate into higher-yielding assets. China eases export restrictions, flooding global markets with previously withheld supply. Technological breakthroughs provide viable substitutes for silver in solar applications, reducing structural demand. Even in this scenario, most analysts acknowledge that significant weakness would attract aggressive buying from both industrial end users, securing supply for future production, and strategic investors, viewing pullbacks as opportunities. The $50 level represents a critical psychological and technical floor. A decisive break below would invalidate the structural bull thesis and likely trigger stops down to $35-$40. However, the bear case faces enormous obstacles. As CBS News notes, the silver market has been running a supply shortfall for several consecutive years, and that imbalance shows no signs of resolving. Mining production cannot increase rapidly, China's strategic motivations for export restrictions won't disappear, and industrial demand for solar EV applications is policy-driven, government mandates, rather than economically sensitive. Now let's get intensely practical because understanding the macro story is worthless if you don't know how to position yourself. I'm going to walk you through access methods, risk management, and strategic considerations, but remember, I'm not a financial advisor and this isn't personalized investment advice. Always consult with qualified professionals before making investment decisions. Access methods, how to gain silver exposure. Physical silver, bars and coins, provides direct ownership and zero counterparty risk. However, premiums on physical silver have skyrocketed during this rally. Small denominations carry 15 to 30% premiums over spot price, while larger bars, 100 Oz 1 kilolin, have tighter spreads of 3-8%. Storage and insurance costs must be factored in, typically running 0.5 to 1% annually for insured vault storage. Physical silver makes sense for long-term holders prioritizing security over liquidity. Silver ETFs offer liquidity, minimal storage costs, and ease of trading. The largest ETFs like SLV, SIVR, and PSLV provide exposure to spot silver prices with tracking errors typically under 0.5% annually. However, ETF investors don't own physical metal and face counterparty risk. Business Today notes that silver ETFs saw record inflows in 2025, suggesting strong institutional and retail demand through these vehicles. Be aware that in severe supply squeezes, ETF prices can trade at significant premiums or discounts to net asset value. Silver mining stocks provide leveraged exposure. When silver rises 20%, quality miners often appreciate 30-40% or more due to operating leverage. However, mining stocks carry company-specific risks, including management quality, jurisdictional risk, political stability of mining locations, production costs, and operational challenges. First Majestic Silver, NYSE, AG, Pan American Silver, NASDAQ, PAS, and Wheaton Precious Metals, NYSE, WPM, represent different risk profiles within the sector. Silver futures and options provide maximum leverage but require sophisticated understanding of derivatives, margin requirements, and rollover costs. The recent COMEX margin requirement increases, implemented due to extreme volatility, make these instruments expensive for retail traders. Generally unsuitable for long-term investors due to complexity and mark-to-market risk. Timing and position sizing. CBS News quotes precious metals expert Jonathan Glosson. My prediction, although I cannot tell the future, is that the price of silver is going to continue to rise in 2026. However, they also note that if the Federal Reserve conducts any rate hikes in 2026, silver prices will likely drop, providing a key risk factor to monitor. Dollar cost averaging, DCA, remains the most prudent approach for most investors. Investing fixed amounts at regular intervals removes emotion and timing risk. Many successful silver investors add to positions on technical pullbacks. $85.90, $80, $75, and $70 represent logical support levels for accumulation. Avoid the temptation to chase parabolic moves above $100 unless you have high conviction and tight risk management. Position sizing should reflect silver's extreme volatility. Even in structural bull markets, silver can correct 20 to 30% in mere weeks. A general guideline: don't invest money you need within 2 to 3 years, as you may be forced to sell during temporary corrections. For balanced portfolios, 5 to 10% allocation to precious metals, including both gold and silver, provides meaningful diversification without excessive concentration risk. More aggressive investors might allocate 10 to 20%, but this requires genuine conviction and emotional discipline. Risk management principles set stop losses or, at minimum, have mental exit points. If your thesis is that silver supply deficits will drive prices to $150, $200, determine in advance what price level would invalidate that thesis, perhaps a close below $60. Having predefined exit criteria prevents emotional decision-making during volatile periods. Avoid excessive leverage. Margin calls during volatile periods have destroyed countless portfolios even when the ultimate direction was correct. If you're using futures or leveraged ETFs, ensure you can withstand 30-40% adverse moves without forced liquidation. Diversify within precious metals. Don't put 100% of your allocation into silver alone. Consider splitting between gold, more stable, larger market, silver, higher upside potential but more volatile, and potentially platinum or palladium for additional diversification. Rebalance periodically. If silver appreciates from 10% to 25% of your portfolio, consider taking partial profits to restore your target allocation. This enforces discipline. Buy low, sell high. Monitor key indicators. COMEX registered inventories, declining, JAS bullish. Lease rates, rising, JAS physical tightness. ETF flows, strong inflows, JAS institutional buying. Gold-silver ratio, compressing, JAS or silver outperforming. And Fed policy trajectory. We've covered an enormous amount of ground in this presentation, from China's export weaponization to institutional price targets of 200 plus, from 5-year structural deficits to the technical cup and handle pattern projecting $250, $300. Now let me distill everything into the essential insights you need to internalize as we navigate 2026 silver market. Stay safe. Thanks for watching.